Every great company, every world-changing product, it starts with just an idea. But how does an idea become, well, a reality? It takes a journey. And that journey almost always kicks off with a quest for funding. So today we're going to map out that entire path from that first little spark of an idea all the way to shaking hands on an investment.
So, let me ask you, you got it, right? That billion-dollar idea, maybe it's scribbled on a napkin somewhere, the one that you just know could change everything.
And that feeling is awesome, isn't it? But here's the thing, passion alone doesn't exactly pay the bills. Even the most brilliant idea in the world runs smack into a very real, very practical question. How do you actually pay for it?
Okay, so this is where the real adventure kicks off. Because every new business, I don't care how brilliant the idea is, it needs money. And it needs it for some very specific and pretty much unavoidable reasons.
Yep. These are the three big hurdles that pretty much every founder has to clear. First up, you've got cash flow challenges. I mean, think about it, right? You have to buy materials, you got to pay your team, run some ads, and that's all before a single customer has even bought your product. Then you have capital investments, the big ticket items, like computers, machinery, or maybe an office space. And finally, long product development cycles. If you're building a really complex app, it could be years before it's ready for market. And all that time, the bills just keep on coming. So, you need money. Where on earth does it come from? Well, before you start knocking on the doors of big-time investors, the quest for funding, it almost always starts way closer to home.
Yeah, your first allies? They're usually you and the people closest to you. It all starts with your personal funds. And that also includes something called sweat equity, which is really just a fancy way of saying that all those sleepless nights and unpaid hours you're pouring into this thing, they have real, measurable value. After that, a lot of founders turn to their friends and family.
But, there's another super powerful tool in your starting kit, bootstrapping. And this isn't just a tactic, it's a whole mindset. It's the art of being incredibly resourceful, of finding clever ways to make progress without needing outside money, just by being creative, thrifty, and, well, just plain smart about it.
So what does bootstrapping actually look like in the real world? Well, it's things like buying used equipment instead of brand new, or maybe leasing a delivery van instead of buying one outright. It's getting really good at convincing your first customers to pay you up front, sharing an office, hiring interns. Every single one of these moves is a way to stretch your precious cash just a little bit further.
All right, so you've stretched your own money as far as it can go. Now it's time to start looking outward. But you can't just wander into a bank or an investor's office totally unprepared. You need a plan. You need a map. And that map has three crucial steps. First, you have to know your destination. Figure out exactly how much money you need. No ballpark figures, you need a precise number. Second, you have to choose your vehicle. What's the right type of funding for your specific business? And third, you need to plot your route. Develop a rock-solid strategy for how you're actually going to approach these people. In all this prep work, it all boils down to one absolutely essential tool. You need what's been called a brief, carefully constructed statement that outlines the merits of a business opportunity. This right here, this is your secret weapon. We call it the elevator pitch. And the idea is really simple. Imagine you have 60 seconds, maybe less, in an elevator with a potential investor. Can you explain the opportunity, your unique solution, why you are the person to pull it off, and who your market is? It's got to be sharp, it's got to be concise, and it has to be absolutely compelling. Okay, now we're at a really big decision point, a major fork in the road. Once you're ready to look for that external capital, you're going to face a fundamental choice: debt or equity. Debt financing is pretty simple to understand. It's a loan. You borrow money, you pay it back with interest, and you keep 100% ownership of your company. With equity funding, you're not taking on any debt. Instead, you're selling a piece of your company, a percentage of ownership, to an investor. They're not just a lender. Nope, they are your new partner. So how in the world do you choose? Well, it really all boils down to risk and reward. If your business is super high risk with a really uncertain payoff, you're probably going to stick with your personal funds and bootstrapping. Now, if it's pretty low risk with predictable profits, a traditional bank loan that's debt financing is probably a great fit. But if you have a totally unique idea with the potential for massive, explosive growth, that's where equity funding comes into play. All right, let's say you've decided equity is the way to go for you. Now, you have to find your allies. So who are these people who invest in startups? You're generally going to meet two main types. On one hand, you have business angels. These are wealthy individuals who are investing their own personal money.
Think of them like patrons for startups. On the other hand, you have venture capitalists, or VCs. These are big firms that invest other people's money from these huge funds. They're more like professional money managers. So let's paint a picture of a business angel. They're often successful entrepreneurs themselves, so they get the struggle. They've been there. They usually write smaller checks, maybe $10,000 up to $500,000, and they're looking for companies that have strong, steady growth potential. And because it's their own cash on the line, they're often more willing to take a chance on a really early-stage company. Now, let's flip the coin and look at a venture capitalist. A VC firm might invest in only 20 or 30 companies from one of their massive funds. And they are not looking for steady growth. No, they are swinging for the fences. They're looking for the next home run that has absolutely massive potential. And that's exactly why they reject almost every proposal they see and put companies through this famously intense investigation process called due diligence before they ever write a check.
And for those lucky few, the ones that actually hit that grand slam, the journey can lead to the very top of the mountain, the initial public offering, or IPO. This is when a company sells its stock to the general public for the very first time. It is a huge milestone. It's the signal that a company has truly, finally arrived.
But hey, let's be real. The journey doesn't always follow that straight, traditional path. There are other creative avenues to explore. Some, you might say, are uncharted territories for funding.
I mean, there are other paths to check out. You could look into leasing to get that equipment you need without a huge upfront cost. You could find strategic partners, larger companies that might share some of your costs in exchange for access to your cool ideas. And hey, don't forget about grants. That's basically free money to help you get your idea off the ground.
So as you can see, there isn't just one single map for this whole journey. From bootstrapping in your garage all the way to ringing the opening bell for an IPO, the path to funding your big idea is absolutely full of choices. So the only real question is, which one are you going to take?